Welcome to a new deep dive, and this one is really laser focused for you. Today, we're navigating the intricacies of using a Luxembourg SOPARFI for cross-border acquisitions.
That's right. Think of it as unlocking a strategic tool set for, well, international deal-making.
Exactly. We're drawing on a recently updated practical guide, blending official Luxembourg regulations with, insights from top legal and financial practices.
And the aim here really is to provide actionable understanding, not just theory, but stuff you can actually use.
Our mission, it's pretty clear, to equip you lawyers, finance professionals, directors, compliance officers, company secretaries with the essential who, what, when, where, why, and how.
Basically, everything you need for effectively using a Luxembourg SOPARFI in international M&A. It's a real shortcut to being well-informed.
We'll be dissecting everything, from the fundamental structure, SA or Sàrl.
To the latest 2025 tax landscape. And that includes the implications of that. 23.87% effective tax rate in Luxembourg City for certain income levels.
Right, that new rate. And there's much more, isn't there? We'll be exploring the powerful participation exemption.
Tax. Yeah, crucial.
Luxembourg's extensive double tax treaty network. Think of it as your global tax passport.
Over 80 treaties now.
Various financing avenues, equity, debt, hybrids.
And the anti-abuse measures. ATAD, DC6, transfer pricing, all key.
Plus, the critical aspect of demonstrating genuine substance in Luxembourg. That keeps coming up.
It does. And then the practical steps.
Mm-hmm.
Executing the acquisition due diligence, SPA nuances, board responsibilities, closing.
And finally, what happens after the deal? The ongoing compliance.
Exactly. Post-acquisition life.
Okay, let's unpack this. When we talk about a SOPARFI as a workhorse for cross-border M&A, what exactly are we looking at?
Well, what's key to understand, I think, is that a SOPARFI, Société de Participation Financière, isn't actually a distinct legal form under Luxembourg law.
Right, it's not like a separate type of company.
No, exactly. It's a regular commercial company, usually an SA, which is a public limited company, or in Sàrl, a private limited company.
Okay.
And its primary purpose is holding financial participations and financing-related entities. It's really the activities and the specific tax rules that define it in this M&A context.
So it's not some kind of, tax haven loophole. It's actually a fully taxable entity. That might seem surprising to some.
It might, but yes. And that full taxability is the crucial bit. It's what unlocks access to Luxembourg's huge network of double tax treaties, like we said, over 80 of them.
Right.
And also the benefits of EU directives, like the parent subsidiary directive. Think of it this way. By being fully in the system, it gets access to the system's advantages for these international deals.
Okay. And it's generally not directly regulated like a bank unless it sort of ventures into those specific regulated activities?
That's correct. Unless a SOPARFI gets into activities needing a specific license, banking, dealing in listed securities, things like that, it generally falls outside the direct supervision of the CSSF, Luxembourg's financial regulator.
Which gives it flexibility, I guess.
It offers operational flexibility, yes, but it also really underscores the importance of demonstrating real economic substance, especially when you're leveraging those tax treaties and EU directives. Foreign tax authorities will be looking to make sure it's not just a shell company.
Makes sense. So, in a practical acquisition scenario, how does the SOPARFI operate? What's its actual role in the deal?
Typically, the SOPARFI is set up as the acquiring entity. So it's the company that actually purchases and holds the shares of the target company, which could be, anywhere else in the world.
Okay.
It can also serve as the central hub for managing the financing of the deal. So channeling funds from investors as equity or acting as the borrower for debt financing.
And besides just holding the shares?
Well, beyond simply holding the acquired shares, it might also hold other strategic assets, like maybe intellectual property related to the acquired business.
Got it. So what are the main advantages then? What makes the SOPARFI such a popular choice for these international deals?
The key draws, really, are the powerful participation exemption packs, which can shield qualifying dividends and capital gains from Luxembourg tax. That's a big one.
Huge.
Then the extensive double tax treaty network, which minimizes withholding taxes coming in and going out. The ability to use EU directives to further cut down on tax leakage.
And overall flexibility.
Yeah, and the overall flexibility and, frankly, relatively moderate setup and running costs compared to some other holding company options or more heavily regulated vehicles.
Okay, so you've decided a SOPARFI is the right tool. Now comes the decision, SA or Sàrl. What are the key things to think about for this choice in an M&A context?
Right, the SA versus Sàrl decision. It often hinges on the specifics of the deal and importantly, what you anticipate for the future of the structure.
Okay. Tell me about the SA first.
So the SA Société Anonyme requires minimum share capital of €30,000, and at least 25% of that has to be paid up when you incorporate. A key feature is that its shares are generally freely transferable, and it's managed by a board of directors, could be one person or more, usually three for listed companies.
And that free transferability is good for?
The SA structure is generally better if you're thinking about public offerings down the line, or just where you need a flexible shareholder base and easy transfer of ownership. For U.S. tax purposes, by the way, under the check-the-box rules, an SA is usually treated as a corporation by default.
Okay, and the Sàrl, how does that compare?
The Sàrl Société à Responsabilité Limitée has a lower minimum capital, €12,000, but it needs to be fully paid up at incorporation.
Fully paid up, okay.
The critical difference for M&A, often, is share transferability. Unlike the SA, transferring Sàrl shares to someone who isn't already a shareholder usually needs approval from shareholders holding at least 75% of the capital.
Ah, 75% approval. That sounds like it could be a significant hurdle, especially for future exits.
It frequently is, yeah. While you can build mechanisms into shareholder agreements to try and manage this, the inherent free transferability of SA shares generally makes it the preferred vehicle if you foresee an easier third-party sale or need streamlined exit processes, like implementing drag-along rights.
Where the majority can force the minority to sell.
Exactly. And the SA structure is also necessary if the company ever wants to go for a public listing.
Makes sense. What about the practical steps then? Setting up either an SA or Sàrl as a SOPARFI? What are the essential procedures?
Well, setting one up involves several mandatory steps. First and foremost, you need to execute the Articles of Association before a Luxembourg notary public. It has to be a notarial deed.
And you generally need to be there or have someone represent you?
Generally, yes. Physical presence or representation through a power of attorney is usually required. A completely virtual incorporation isn't the standard route here.
Okay. What's next after the notary?
After the notarial deed, the minimum paid-up share capital, that 25% for the SA or 100% for the Sàrl, must be deposited into a dedicated Luxembourg bank account. The bank then issues what's called a blocking certificate to confirm the deposit.
Right, the blocking certificate.
Then, registration. The company needs to be registered with the Luxembourg Trade, and companies register the RCS using their online platform, the LBR. This registration is what actually gives the SOPARFI its legal personality.
And that online filing needs a Lux Trust certificate for authentication.
That's right. You need that for secure access. Finally, key information extracts of the articles, details of the directors or managers, gets published in the official electronic gazette, the RSA, again via the LBR platform.
Okay. One thing people often ask about is the business permit, the autorisation d'établissement. Do SOPARFIs typically need one?
That's a good question. Interestingly, a SOPARFI whose sole or main activity is just holding financial participations and maybe doing some related intragroup financing generally does not need a business permit.
Oh.
However, if the SOPARFI plans to do more, like engage in broader commercial activities, industrial work, regulated professions, or more extensive financial services beyond its core holding role, then yes, getting a business permit from the Ministry of the Economy is usually mandatory.
So you need to check carefully based on planned activities.
Absolutely. It's crucial to verify the specific requirements based on exactly what the SOPARFI will be doing. The government portal, guichet.eu, is the best place to check that.
Right. Let's pivot to the tax landscape then. This is obviously critical for SOPARFIs. What are the fundamental taxes it's subject to, keeping those 2025 updates in mind?
Okay, so as we established, the SOPARFI is a fully taxable Luxembourg resident company. That means it's subject to corporate income tax, CIT, municipal business tax, MBT, and net wealth tax, NWT.
And that full taxability is the key to the Trini benefit.
Exactly. It's the gateway.
And the main CIT rate saw a slight reduction for 2025, didn't it?
Yes, that's right. The standard CIT rate dropped slightly from 17% to 16%, effective January 1st, 2025. Now, when you combine that with the 7% solidarity surcharge and the MBT, which is 6.75% in Luxembourg City, for example, the maximum aggregate income tax rate in Luxembourg City for companies with taxable income over $200,000 is now 23.87%.
23.87%.
And it's worth noting there are lower CIT rates for companies with taxable income below that threshold. This small reduction is really about keeping Luxembourg competitive internationally.
Okay. And there were also changes to net wealth tax for 2025, I recall. Something about the minimum tax.
Absolutely. NWT is an annual tax, 0.5% on the company's net assets, up to $500 million, and 0.05% above that.
Right.
Significantly, participations that qualify for the participation exemption are also exempt from NWT. This is helpful.
Good point.
The key reform for 2025, though, concerns the minimum NWT. That old fixed minimum of $4,815 for SOPARFIs holding mostly financial assets, that's gone, abolished after a constitutional court ruling.
Ah, okay. So what's the system now?
Yeah, the minimum NWT is based on a progressive scale from 535 up to 4,815 euro, and it's determined solely by the company's total balance sheet size.
So it's no longer about the type of assets, just the overall size of the company.
Precisely. It's seen as a more equitable and legally sound approach, directly responding to that court ruling.
Right. Now, let's delve into probably the biggest draw for using a SOPARFI, the participation exemption, or PEX. How exactly does this shield dividends and capital gains from tax?
PEX is definitely a cornerstone. It's mainly covered in Articles 147 and 166 of the income tax law. Essentially, it can provide a full 100% exemption from both CIT and MBT on qualifying income.
Which includes?
Dividends received by the SOPARFI, capital gains realized from selling shares in subsidiaries, and also liquidation proceeds from these qualifying participations.
Okay, a 100% exemption sounds fantastic, but obviously there are conditions. It's not automatic for just any shareholding, right?
No, exactly. There are several cumulative criteria you absolutely have to meet.
Such as?
Okay, first, the parent your SOPARFI must be a fully taxable Luxembourg company or a qualifying PE in Luxembourg. Second, the subsidiary needs to qualify.
What makes a subsidiary qualify?
It either needs to fall within the scope of the EU Parent Subsidiary Directive, or be another fully taxable Luxembourg company, or be a non-resident company that's subject to a comparable level of income tax. Generally, that means a nominal rate of at least 8.5% since 2019.
Wait, 8.5% comparable tax. Got it. And there are minimum holding requirements too. Percentage or value?
Yes. The SOPARFI has to hold either at least 10% of the subsidiary's share capital or R, have an acquisition cost of at least $1.2 million for dividends and liquidation proceeds,
1.2 million.
or at least $6 million for capital gains when selling the shares.
6 million for gains.
Okay. And crucially, you have to meet this threshold, whichever one applies, for an uninterrupted period of at least 12 months.
12 months uninterrupted. And simple capital contributions might not count towards those thresholds.
That's a nuance, yeah. Just putting money into surplus accounts without issuing new shares might not count towards hitting those 1.2 meters or 6 meter thresholds. You need to be careful there.
Given Luxembourg's in the EU, I assume there are anti-abuse provisions to stop people misusing this.
Absolutely. Luxembourg's PEX rules incorporate the ATAD anti-abuse provisions.
Hey.
So the exemption can be denied if, for example, the dividend payment is deductible for the subsidiary paying it.
Oh, okay.
Or if the whole setup is deemed non-genuine, meaning it looks like it was put in place primarily just to get a tax advantage that goes against the spirit of the law.
Right, the substance point again. Now, I understand there's a new option introduced in 2025 regarding PEX, something about an elective waiver.
Yes, this is a pretty interesting development for 2025. Luxembourg introduced an optional annual waiver of the PEX. You can choose, per participation, not to apply the exemption.
Why would you do that?
Well, this waiver is only available if you qualify for PEX solely based on the acquisition cost thresholds, the 1.2 meters or 6 liters, and not because you hold 10% or more.
Okay.
It gives flexibility, particularly if those SOPARFI has tax losses it wants to use against income that would otherwise be exempt. It could also be relevant for groups dealing with the Pillar 2 global minimum tax rules.
Interesting. So more flexibility there. And just to confirm, PEX qualifying participations are also exempt from net wealth tax.
Correct. That's another important benefit.
So PEX is powerful, but you need to be rigorous about the conditions and aware of these new options. Let's move to withholding taxes, WHT, on flows in and out of the SOPARFI. What's the general picture?
Luxembourg generally has a favorable WHT regime for international stuff. For dividends came out by a SOPAR into its shareholders, the standard domestic rate is 15%.
15%. But are there exemptions?
Yes, there's a full exemption under the parent subsidiary directive implementation if the dividend goes to a qualifying parent company, think EU or treaty country parent, subject to comparable tax that meets the same holding requirements as for PEX.
Yeah.
10% or 1.2 million acquisition cost, held for 12 months.
Subject to the anti-abuse rules again, presumably?
Subject to anti-abuse rules, yes. And of course, Luxembourg's double tax treaties might also reduce that 15% rate for shareholders in treaty countries.
What about interest and royalties paid out by the SOPARFI?
Generally, good news here. Luxembourg usually doesn't levy any withholding tax on arm's-length interest payments made to non-residents.
No WHT on interest. That's significant for debt financing.
It's a major advantage, yes. There are very limited exceptions. Similarly, royalty payments to non-residents are also generally exempt from WHT in Luxembourg, and liquidation proceeds are also WHT exempt.
Okay. And when income like dividends, interest, or royalties flows into the SOPARFI from foreign subsidiaries, what's the WHT situation there?
This is where Luxembourg's treaty network and the EU directives, parent subsidiary, and interest and royalties really come into play. They often significantly reduce or even completely eliminate foreign WHT that would otherwise be imposed on payments coming into the Luxembourg SOPARFI from subsidiaries in treaty partner countries or other EU states.
So that double tax treaty network is vital. How does the SOPARFI actually leverage these treaties?
Well, as a fully taxable resident, a SOPARFI is generally entitled to claim treaty benefits. The main advantages are reduced WHT rates from the source country, rules allocating who gets to tax capital gains, and mechanisms to avoid double taxation, usually a tax credit or an exemption in Luxembourg for tax already paid abroad.
And it's worth remembering that sometimes Luxembourg's own domestic law, like PECs or no WHT on interest, might actually be better than the treaty.
Precisely. Often, domestic law offers the best outcome. But the treaty network is still crucial for cutting source country WHT and for situations where domestic exemptions don't fully cover it.
And we need to be aware of the BEPS impact.
Yes, definitely. The OECD's BPS project, especially the Multilateral Instrument, or MLI, has tightened things up. It introduced stricter anti-abuse rules like the Principal Purpose Test, PPT, into many treaties.
The PPT.
Which means you really need to demonstrate that getting the treaty benefit wasn't the main purpose of your structure and that you have genuine economic substance backing it up.
Okay. Finally, on tax, let's quickly touch on the IP box regime. Does this often play a role in SOPARFI acquisitions?
It can, in specific cases, especially if the target business holds significant qualifying intellectual property. Luxembourg has an optional IP tax regime compliant with the OECD's Nexus approach.
And the benefit is?
It offers an 80% exemption from CIT and MBT on net income from commercializing qualifying IP patents, copyrighted software, things like that. Marketing IP is usually excluded.
80% exemption sounds very attractive. Leads to a low effective rate.
It can result in an effective tax rate below 5% on that income. Plus, the qualifying IP itself is 100% exempt from net wealth tax.
But there are strings attached.
Oh yes, stringent conditions. The IP must come from the company's own eligible R&D activities. And the benefit is linked to how much qualifying R&D spend you actually have, the Nexus ratio. You need meticulous records. So it's really best suited for SOPARFIs actively doing significant R&D and holding substantial qualifying IP.
Okay. We've covered setup and the complex tax landscape. Now, how is a SOPARFI typically financed for an acquisition? What's the usual capital structure mix?
Financing usually involves a blend of equity, debt, and sometimes hybrid instruments.
Let's start with equity.
Equity can be traditional share capital, share premium, that's the amount paid above nominal value, and also contributions to a capital surplus account, often called Account 115.
Account 115.
Yeah, it offers flexibility for later funding, potentially avoiding a formal share issue and notary involvement. You can also create different classes of shares with varied voting or dividend rights.
Okay. And common debt financing options.
Standard bank loans, issuing bonds, maybe convertible ones, subordinated notes, warrants. These are all common. And as we said, arm's length interest is generally deductible and WHT-free when paid out.
We mentioned hybrid instruments earlier. Can you elaborate on their use?
Hybrids like PECs, preferred equity certificates, CPECs, convertible PECs, profit participating loans. They have features of both debt and equity.
Right.
Historically, they were sometimes structured to get debt treatment in Luxembourg for tax deductions, but maybe equity treatment elsewhere. However, the ATAD2 anti-hybrid rules mean you have to be really careful now.
To avoid mismatches.
Exactly. To avoid deduction non-inclusion mismatches or double deductions. Very careful assessment is needed.
Now, I've often heard about this 85.15 rule of thumb in Luxembourg regarding debt-equity ratios. What does that mean for financing a SOPARFI acquisition?
Yes, the 85.15 rule. It's an important administrative practice from the Luxembourg tax authorities. It acts as a guideline, a sort of safe harbor, particularly for related party debt financing, used by a SOPARFI to buy shares in a target.
So if the ratio of related party debt to equity stays within 85.15,
Then the interest expense is generally considered deductible, provided the interest rate itself is arm's length.
and what happens if you go over that 85.15 ratio?
If you significantly exceed it, the tax authorities might scrutinize the excess debt. They could potentially recharacterize it as hidden equity.
Which means
Adverse tax consequences, like disallowing interest deductions on that equity portion and maybe treating the interest payments as hidden dividends, which could then attract withholding tax.
okay. Does this apply to all debt?
It primarily applies to interest-bearing related party debt used for financing participations. Interest-free shareholder loans are usually treated as equity anyway, and third-party debt is generally assessed on arm's-length terms, not strictly by the 85.15 rule. But even within the 85.15 ratio, the interest rate must always be arm's length.
Speaking of arm's length, what are the key transfer pricing TP considerations for intragroup financing when a SOPARFI is involved?
The arm's length principle is paramount. It's enshrined in Luxembourg tax law, Articles 56 and 56Bs, and aligns with the OECD guidelines.
So terms must be like those between independent parties.
Exactly. The terms of any intragroup financial transaction, like the interest rate on a loan, must be comparable to what independent parties would agree on in similar circumstances. You need a solid comparability analysis to justify that rate.
Is there a requirement to proactively file detailed TP documentation in Luxembourg, like master files or local files?
Currently, there isn't a general mandatory requirement for proactive filing of full TP docs for everyone.
But you need to be ready to justify it.
Absolutely. Taxpayers must be able to justify their TP policies and the arm's-length nature of their related party deals if the tax authorities, the ACD, ask. The annual tax return does require disclosing related party transactions, though.
And there's talk of more formal requirements coming.
There has been discussion, yes. Potential future implementation of more formal documentation requirements, possibly aligning more closely with international standards. So, watch this space.
Substance seems to be the recurring theme. How does it link to intragroup financing and TP?
It's absolutely critical. There's specific guidance in ACD circular on the substance expected for financing entities in Luxembourg.
What does it emphasize?
It stresses adequate decision-making capabilities in Luxembourg, exercising control over the risks of the financing activities, and having enough equity to support these functions.
And a lack of substance.
Can lead the tax authorities to challenge interest deductions and potentially disregard the TP arrangements altogether. Global scrutiny on intragroup financing is increasing, looking at debt capacity, credit ratings, the business purpose. There's another circular providing benchmarks for intragroup current accounts, too.
Okay, we've covered tax and financing complexities. Let's tackle the crucial area of anti-avoidance rules and that vital concept of substance. Where do we start with ATAD?
Right, ATAD, the EU's anti-tax avoidance directive. Luxembourg has implemented several key provisions. One very relevant one for M&A is the interest limitation rule, Article 168D of the tax law.
How does that work?
It limits how much exceeding borrowing costs a company can deduct. It's capped at the higher of 30% of its taxable EBITDA, or a $3 million safe harbor threshold.
And borrowing costs is defined broadly.
Very broadly, yes. Includes various interest expenses. There are some exemptions, standalone entities, certain financial undertakings, though one exemption is being looked at by the ECJ. Grandfathered loans from before mid-2016, public infrastructure loans. There's also a group ratio escape clause, and the 2025 changes introduced a single entity group concept for that.
What happens to interest you can't deduct?
Disallowed interest can be carried forward indefinitely, and any unused interest capacity under the 30% limit can be carried forward for 5 years.
Okay. What about the general anti-abuse rule, the GAR?
Luxembourg's GAR, updated for ATAD, allows tax authorities to disregard arrangements that aren't genuine, meaning they lack valid commercial reasons reflecting economic reality if a main purpose was getting a tax advantage that defeats the law's object. It's broad.
Right, and the specific rules targeting hybrid mismatches under ATAD 2.
ATAD 2 aims to neutralize tax advantages from differences in how instruments or entities are characterized legally between jurisdictions, especially involving related companies or structured deals.
How does it neutralize them?
Through primary rules denying a deduction or requiring income inclusion to counteract double deductions, D80, or deduction without inclusion, DNI. If the primary rule isn't applied elsewhere, secondary rules kick in. There's also an imported mismatch rule.
Okay.
Interestingly, there's a sort of de minimis for small investors in investment funds holding less than 10%, not acting together. They're presumed not part of a structured arrangement for these rules.
ATAD seems quite comprehensive. Any other related rules relevant for SOPARFIs and M&A?
Yes, controlled foreign companies, CFC rules, could be relevant. They might attribute undistributed income from a low-tax foreign sub back to the Luxembourg parent in certain cases.
Okay.
And revised exit taxation rules, imposing tax on unrealized gains if a company moves its residence or business out of Luxembourg, though payment deferral might be possible for UEIO moves. The key takeaway is these rules can interact. Compliance with one doesn't mean you're clear on others. You need a holistic view.
Got it. Let's turn to DESI 6 reporting. Mandatory reporting of certain cross-border tax arrangements. How does this hit M&A deals with SOPARFIs?
DAC 6 requires reporting potentially aggressive cross-border tax planning arrangements that meet specific hallmarks. The reporting obligation usually falls on intermediaries, advisors, lawyers, accountants.
But it can shift to the taxpayer.
Yes, if there's no EU intermediary, or if they claim legal professional privilege, LPP. In Luxembourg, intermediaries claiming LPP can notify others involved, shifting the burden.
What kind of M&A structures might trigger DC6 reporting?
Several common techniques could. Acquiring a loss company to use its losses, transactions converting income to capital, circular transactions, deductible payments to low tax recipients, hybrid mismatches, transferring hard-to-value intangibles.
Okay, quite a few possibilities.
Transfers significantly reducing the seller's EBIT, arrangements undermining information exchange, or obscuring beneficial ownership. Many hallmarks also need the main benefit test to be met, meaning a main benefit was obtaining a tax advantage.
What's the reporting process in Luxembourg? And the penalties?
It's electronic reporting via myguichet.eu using XML format. The deadline is tight, usually 30 days from the first trigger event, like when the arrangement is ready to go.
And penalties?
Can be significant, up to 250,000 euro for noncompliance. So proactive DAC 6 assessment is really integral to M&A planning now, not just an afterthought at closing.
We keep coming back to substance. Can you elaborate on what counts as adequate economic substance for a SOPARFI in Luxembourg, especially for cross-border deals?
Demonstrating substance is crucial, absolutely vital for accessing treaty benefits post-MLIPT, relying on EU directives, defending against GAA or foreign anti-abuse rules, and supporting your transfer pricing.
Is there a simple checklist?
Unfortunately, no single legal checklist. It's assessed case by case, considering what the SOPARFI actually does and what foreign tax authorities expect.
So what are the common indicators they look for?
Things like having qualified directors, ideally a majority resident in Lux, actively managing the company, holding real board meetings in Luxembourg, having dedicated office space, employing local staff suitable for the activity level, using Luxembourg bank accounts actively, keeping accounting records in Luxembourg, and fundamentally demonstrating the SOPARFI bears the risks and controls its activities. It costs money to build substance, but it's a necessary investment for long-term viability. The required level depends on the SOPARFI's role and, frankly, evolving international standards.
Okay, foundational aspects covered. Let's get practical, executing the acquisition. What are the initial strategic choices when structuring the deal through a SOPARFI, share deal versus asset deal?
Right. The structure choice share deal or asset deal has massive legal, tax, and commercial knock-on effects.
Tell me about a share deal first.
In a share deal, the SOPARFI buys the shares of the target. The target company continues to exist with all its assets, liabilities, history. The seller might get tax breaks on the sale. Target's tax attributes usually stay with it. In Luxembourg, share transfers are typically free of registration duty VAT. It's often simpler execution-wise for the whole business, but carries higher risk of inheriting hidden liabilities. That's why deep due diligence is non-negotiable. Share deals are typical when buying a whole operating business.
And an asset deal using a SOPARFI.
Here, the SOPARFI buys specific assets and maybe assumes specific liabilities. For the seller, this usually triggers taxable gains on the asset sold. The buyer, your SOPARFI, gets a stepped-up tax basis in those assets, good for future depreciation.
Any tax implications on the transfer itself?
Depending on the assets in Luxembourg, VAT could apply unless it's a transfer of a going concern, TOGC. Real estate transfer tax might apply too if Lux property is involved. Asset deals are more complex to execute individual transfers. Consent's needed, but you get to cherry-pick assets' liabilities, reducing inherited risk. More common for specific business lines or assets.
Once the structure is decided, due diligence is key. What's the focus when a SOPARFI is involved, either buying or being bought?
Okay, if the SOPARFI is the buyer looking at a foreign target, You absolutely need to check the target's tax status for PEC's eligibility, comparable tax rate, compliance history, assess potential WHTM distributions to the SOPARFI, and treaty benefits. Scrutinize the target's historical tax compliance, TP policies, any exposures. Check change of control impacts.
And if the SOPARFI itself is the target being acquired?
Then the buyer's DD will hammer the SOPARFI's corporate standing, its own tax compliance, CIT, MBT, NWT, VAT, PECs, WHT, TP, substance its financials, debt, and regulatory compliance like RBE filings and AML-CFT procedures.
So you need to tailor the DD list.
Definitely. Generic lists are enough. You must assess the combined SOPARFI target structure for the intended tax benefits and anti-abuse compliance.
After D-Day comes negotiation, the SPA or APA, any key clauses with a particular Luxembourg angle.
Even if the main agreement is under, say, English law, certain clauses need a Lux lens. Representations and warranties, RNWs, are crucial.
What should they cover specifically for Lux?
Explicitly cover Lux tax compliance, PEC's eligibility on future dividends, WHT application, TP adherence, RBE compliance. Scope, duration, limitations are big negotiation points.
What else?
Indemnities need tailoring for risks found in DD. Conditions precedent might include Lux regulatory nods. Purchase price mechanism needs clarity. Closing mechanics detailed. Post-closing covenants are standard. If it's in Sàrl target, the SPA must address that shareholder approval requirement for the transfer. And W&I insurance is increasingly common, affecting how R&W indemnities are negotiated.
What about the board or managers of the SOPARFI itself during M&A? What are their duties?
Directors, SA, or managers, Sàrl, have fiduciary duties, care, loyalty, confidentiality. Crucially, they must act in the SOPARFI's corporate interest, its own best interests. They need to document the benefit to the SOPARFI for the deal.
So formal approvals are needed.
Yes, formal board resolutions for key M&A steps. Check articles and shareholder agreements too. They must declare and avoid conflicts of interest. Act fairly towards minority shareholders. Breaching duties can mean personal liability, civil, or even criminal. Hence, D&O insurance is common.
What does the actual closing of a cross-border deal involving a SOPARFI look like? Any checklist items?
Closing needs meticulous planning. A detailed checklist is vital. It covers pre-closing checks, CPs met, payment mechanics, share asset transfer execution, governance changes, director resignations appointments, document delivery, certificates, resolutions, opinions, signing ancillary docs, planning post-closing filings in both Lux and the target jurisdiction. Requires tight coordination between counsel in both places.
Finally, any regulatory hurdles beyond company law, merger control, FDI?
Yes, several possibilities. Merger control could be EU level if thresholds are met. Luxembourg national thresholds are high, less likely for foreign target deals via SOPARFI, but Article 22 EUMR referrals are possible.
And foreign direct investment screening.
That's a big one now. In Luxembourg, effective September 2023, mandatory notification authorization for non-EEA investments leading to control of Lux entities in critical sectors, energy, finance, etc.
So when is it relevant?
Primarily if the SOPARFI itself is acquired by a non-EEA investor or if the foreign target has Lux-based critical activities. If the target is a regulated Lux financial institution, you'll need CSSF ECB approval too. National FDI rules in the target's country also need checking. It adds complexity.
We've closed the deal. Phew. But it's not over, right?
Yeah.
What does ongoing compliance look like for the SOPARFI post-acquisition?
Absolutely not over. The ongoing compliance burden is significant. You've got annual accounts preparation and filing under Lux GAAP, shareholder approval, RCS filing within 7 months, audits for larger entities,
Tax filings.
annual CIT, MBT, NWT returns, usually by May 31st. VA returns is applicable. Crucially, keeping the Register of Beneficial Owners, RBE info, up to date and filed. The LBR is enforcing this more now. Ongoing anti-money laundering, counter-financing of terrorism obligations, policies, procedures, CDD monitoring. Maybe an AML officer needed.
Anything else?
If part of a large M&E group, potentially country-by-country reporting, CBCR, ongoing monitoring for new DC-6 reportable arrangements, and of course, continuously reviewing and ensuring adequate, demonstrable economic substance. It often means using specialized service providers.
And beyond pure compliance, there's integrating the acquired business practically.
Yes, post-acquisition integration, aligning governance, reporting lines, consolidating finance and tax, managing cash flows, watch TP, implementing the tax strategy using that PECs, managing acquired tax attributes, if it's an operating business, realizing synergies, and periodic reviews of the whole structure's efficiency and compliance.
This has been incredibly detailed. A real deep dive into using a Luxembourg SOPARFI for cross-border M&A. It's clear it offers huge advantages, but wow, the complexity demands real expertise and careful planning.
Absolutely. Success really hinges on getting the structure right up front, executing diligently, and keeping a constant eye on the evolving legal, tax, and regulatory landscape.
Hmm.
You really need experienced Luxembourg advisors, legal, tax, financial involved throughout the whole process.
What specific aspects of Luxembourg fund structuring or maybe other cross-border acquisition techniques are top of mind for you right now? We really encourage you to delve deeper into these topics, and please reach out with any follow-up questions you might have.
Hit that subscribe button. This has been the Luxembourg Fundcast for you today.